Okay. Thank you, Erica and Dorian.
All right. Thanks, Hope and Kenya. Yeah, welcome. Today we're going to be talking about advising beginning farmers. My name is Erica Sato. I'm a staff attorney at the Law Center. I work with a lot of our land-based clients as well as doing um, financial and internal stuff for SELC. Dorian, do you want to introduce yourself?
Sure. It's good to be with y'all. My name's Dorian Bayan. I also mostly work with our land clients. Yeah, generally land work very closely with Erica in a lot of our work. And we're really excited to be able to host a legal cafe for farmers today. I was a farmer myself for a couple of years before joining the Law Center, so it feels nice to have these resources.
Thanks, Dorian. So today we're going to talk about what is Agroecology Commons. It's the organization that we're partnering with to put this event on. Dorian is going to present a little bit about employment law and shared ownership and just generally how it works to work with other people. And then I'm going to talk a little bit about taxes that might be useful for beginning farmers, and then we'll close and hopefully have a little bit of time for Q&A. And yeah, before we begin, we just want to say thank you to California Farm Link. Dorian and I took their class on advising farmers, evaluating and supporting farmers, ranchers, and fisher clients last year. And that's where a bunch of this information comes from. So huge shout out to instructors Poppy Davis and Asia Hampton. All right, Dorian, take it away.
Yeah, so we're here today in large part because of a partnership we've developed with Agroecology Commons. I think they're a great organization here in the Bay Area. So I'm just going to give you a little bit of context of why we're here today and under what arc, we're organizing under basically. So you can take us over to the next slide. So Agroecology Commons is a nonprofit formed to essentially promote agroecology as a social movement. I feel like agroecology as a word maybe isn't as much in our vernacular as like regenerative agriculture or organic agriculture. It's very similar, I think, in one way that agroecology differs, which is I think the critical piece is that it's just as much a technical, sort of scientific field as it is a social movement. So agro, cultivation of food, ecology, really talks about the scope of the management system, which is at the ecosystem level. It really encourages land stewards and farmers in general to think beyond the fence line and how they are nesting their practices in a larger ecosystem. And I think my favorite part about agroecology and what Agroecology Commons is doing is the pedagogy, which is called the peasant to peasant, campesina campesine, or the farmer to farmer pedagogy, basically saying our learning is horizontal. Yes, we're a scientific study, but mostly agroecology is giving a name to practices that have existed for millennia, traditional ecological knowledge and peasant knowledge. So we're here to basically disseminate this information horizontally. And we're seeing ourselves as part of this network. I think part of agroecology is also learning how to navigate the sort of social and legal systems that we're embedded in. Agroecology Commons has launched this program in the Bay Area called the Farmer to Farmer Training. So this is why we're here today. We're sort of part of the agro ecosystem, I guess you can say. Next slide. So I'm just going to quickly talk about employment law, just some basics. I think especially with beginning farmers, this is one thing that gets a little tricky as far as classification goes. I think it's good to, when beginning to advise farmers, to really ground the conversation in that and sort of knowing who's taking part of these activities and how they're classifying. Next slide, please. So Oh, the one before. Yeah, just quickly, much of California law tethers on the question of whether someone is an employee or an independent contractor. That's going to be a big question. It's important to avoid these misclassifications early on, especially so that workers are protected and also farmers aren't increasing their liability and running any risks down the line. All right, next slide. So generally in the state of California, it's presumed that a worker is an employee unless it can be proven otherwise. So AB5, and this is of course specific to state law and it's specific to wages, but AB5 basically introduced the ABC test, which is the burden of proof you have to meet in order to be able to show that someone is an independent contractor versus an employee. So you must prove that A, the worker is free from the control and direction of the hiring entity in connection with the performance of the work. B, the worker performs tasks that are outside the usual course of the hiring entity's business. And C, they're engaged in an independently established trade, occupation, or business of the same nature as the work performed for the entity. Here in this ABC test, really part B is the one that's going to be the most challenging to meet when we're thinking of independent contractors versus employees, because so much of what a farm business will hire, someone to work for, it really doesn't, it's hard to classify something outside of the scope of the business of farming, especially because of the amount of activities that are happening. So, if you're trying to contract a harvester, for example, who does like temporary harvesting, that's going to be kind of challenging to fit because harvesting is an essential activity of the farming business, for example. But this is something that you want to take into consideration. It's one of the main tests. Another thing that we're going to get a lot is the classification of employees, and when you're working with family members, who should be considered an employee and who's possibly exempt. Again, some family members are going to be exempt while others are not. So again, to be exempt means not having to classify as an employee, which means you don't have to pay yourself or give yourself the protections that an employee would have. Generally, immediate family members differ from family at large. So things like spouse, parents, or children are considered immediate family and will be classified as family members. But other members of the extended family might have to be considered employees. So you'll just want to make sure to really get a feel for how the dynamic is at play, just to make sure that, we're not misclassifying certain family members. And of course, minor children are also covered by child labor law protections. Next slide. There's also other exemptions. So there's interns, of course. Interns can be classified as exempt and not employees, but only if the work of the intern is primarily benefiting the intern and not so much the business. And this is usually happening through a program that's accredited. Volunteers also in a for-profit business, you essentially can't volunteer through a for-profit business. So unless the volunteer is operating through a nonprofit organization, you'll have to classify them as an employee. And owners, of course, themselves usually don't pay themselves and often choose not to view themselves as their own employees. They can opt in as employees in order to get things like workers' comp, for example. Next slide. So just to go into ownership a little more and in the concept of shared ownership, an owner is considered someone who has capital invested in the business. So that means like money, equipment, or a note payable in the instance that they can't actually put money down. It's someone who also shares profits and losses, and an owner should be reflected in the balance sheet of the business. We'll likely see a lot of things like sweat equity come up, right, in the instance that someone doesn't have the money to put down. So it's generally been advised that has to be classified in some way so that it's just not sort of existing unwritten or unspoken or, as an oral agreement. So maybe having it be written as a note payable and then be accounted for in the balance sheet would be good. Or if, for example, you have no money, but you have a tractor that you can sort of put in as a buy-in, that can be classified as member capital as well. Next slide. These are some just questions to consider. I think that'll come up really quick, right? So we want to think about the land where people are operating, what sort of agreements are in place, who's making contributions to the business and in what way. Is the person on payroll? What sort of agreements are in place? Is a person married, like actually legally married? For multiple owners, what contributions are there? What are the percentages? Does the balance sheet, if they have one, reflect that? And yeah, is there something in the like of sweat equity that is being properly classified or not? Next slide. Single owners versus partners. So I think this one's one that has been driven home a lot. People will say they're together or they're with a partner, but we have to make sure that they're legally married. So if partners are not legally married, they should be filing taxes as a partnership or an S corp. So a partnership is, basically like an unincorporated association. So they'll have no corporate shield, less liability protections. S corps are basically a tax classification, and they're a pass-through taxation scheme that can be stamped on something like an LLC, and this would help you avoid double taxation. In S corps, you can claim note payables from business, which is what we were speaking about earlier. But the most important thing to remember here is that, yeah, no member capital is present. They're not considered an owner, or any sort of contribution that isn't being accounted for. They're not considered an owner. And now I'll pass it over to Erica.
Thanks, Dorian. All right, so taxes. This is also pretty complicated, but hopefully we can give you guys a couple of tools for approaching this. So first, it's important to inform your clients why they should care about filing their taxes. A lot of people think that if I'm not required to file taxes for my farm business, like I didn't make a profit, then I don't really need to deal with it. But actually, the losses can be a benefit. They can offset other income that you have that you're getting from other sources, or they can even be carried forward sometimes to offset future income. So that's just something to be aware of. And then another key piece to know is that there are different types of income and losses, and you can't just mix and match them. Different rules apply. So in general, losses can only offset income of the same type. And there's, ordinary income and expenses, capital gains, self-employment, active, passive, pass-through. So like if you're thinking about a dairy farm business, maybe the farmer is selling milk, that's ordinary business income. But if they're selling the cows that produce the milk, then that would be capital gains income from selling assets. So just, make sure that people kind of understand the difference between those things for their taxes, or are getting help for that. And another important piece for farmers is assets and how to manage them, because farms have a lot of assets. So it's important for clients to always keep a list of their business assets, and that they set things up correctly when they first get the assets so that they can maximize their tax benefits. So I'm just going to introduce a couple of terms here. So when you first acquire an asset, you'll get a basis in that asset, and that just means it's a term that kind of means like the value that you have in the asset. So like the most basic rule is that if you buy it, then the basis is just the purchase price of what you paid for it. And it's important to keep track of that basis over time on your balance sheet, because when you later sell the asset, then your gain or loss will be compared to the basis to get your capital gain or loss. So the other term is depreciation. And this is the way that taxes account for how an asset loses value or is kind of used up over time. So when you buy a big asset like a tractor, you can't just, deduct the cost as a business expense. You have to deduct it slowly over a number of years, and that's what depreciation is. So there are different rules for depreciation depending on the type of asset, but um, um, you claim the depreciation as an expense on your taxes, and then by doing that, it reduces your basis in the asset also by the same amount. So all of that's a little bit complicated, but just know that it's really important for people to set things up correctly at the beginning, and then also make sure that they're claiming that depreciation every year on their taxes, or yeah, because otherwise the depreciation benefit will be lost and the basis will still decrease, but you won't be able to take advantage of that. Okay, another rule that's good to know for small farmers especially is the hobby loss rule. And this rule was kind of not written with like subsistence farmers in mind, so it's not super clear how they apply towards things like that, but we'll talk a little bit about the parameters. So, um, as lawyers, practitioners, we have to be careful when we're using these terms like hobby and lifestyle, because they can be seen as derogatory terms for like people who are in the farming business. But the bottom line is that under the tax rules, you can't deduct any of your business expenses if what you're doing is not actually considered a business. So what really matters for that is that you have a profit motive. So you can show that you have a profit motive in a couple of different ways. One, obviously, is by actually making a profit, bringing in income that exceeds expenses. But even if you don't have that, you can also show that you're making a profit through appreciation of assets that you own. So if you own the real estate that you're farming on, you might be improving that property value. Maybe you're planting fruit trees or otherwise building up your profit-making capacity. And so that would also count as making a profit. If you're not doing either of those things, the IRS will take a look at your profits. They look at like the last 5 years, and if you made a profit in the last 3 out of 5 years, then there's a presumption of profit motive. If you haven't made a profit in the last 3 out of 5 years, you can that's still okay, but you just need to show that you have a profit motive. And so you can do that by making changes in your operations over time to try to improve the business's profitability. And if you're consistently running at a loss and you're not making any changes, that's where it really starts to look more like a hobby. And so then your clients could be in trouble if you get audited or if they get audited. Okay, just a little bit about self-employment income. Um, so if you're like me and you've only ever worked a W-2 job, this might be unfamiliar. So self-employment income is income that's reported on Schedule C, F, and E. That's farm, non-farm profit and loss, and then like pass-through profit and loss from an LLC or a partnership, as well as rental profit and loss. And the self-employment tax is 15%. So that kind of accounts for Social Security and Medicare taxes. And it accounts for both sides. So it would be on a W-2 employee and employer would normally each pay half. For self-employment, you pay the whole thing. But the IRS really wants to incentivize people actually paying this. So what they did is they more than offset it with the qualified business income deduction of 20%. So this is a pretty good deal. Pretty much all of the income that you would report on schedules C, F, and E will be treated like this, except that rental income is not subject to the self-employment tax, but you still get the qualified business income deduction. And this is applied after the qualified business income deduction is applied after you take either the standard or your itemized deductions, so it's unrelated to that. Okay, another important situation that comes up for a lot of small farmers is mixed use assets. So if your client owns real estate where they live and they operate their farming business, it can be a little confusing how to treat that asset. Um, excuse me, as business advice, we learned from California Farm Link that best practice is to own your home outside of the business and then lease it to the business and pay yourself rent. And that kind of just limits the liability and reduces income taxes. In terms of how you'll report this on your taxes, this is another situation where it's really important that you set it up correctly at the beginning so that you can reap the benefits down the line. So just, making sure that your clients get that tax advice if they're trying to do something like this. But basically, for mixed use assets, you'll want to get a farm appraisal, which can be done by farm appraisers after you purchase the property. And the farm appraiser will tell you exactly what percentage of the property value is being used for the residential part and what percentage is attributable to the business part. And you can tell them, like, to the extent possible within their judgment, you want them to put the minimum value on the residential and the maximum value on the business side. And that percentage will then be used to allocate everything between the business and the personal stuff. So including things like expenses, like insurance, which is deductible for businesses, but not for personal residences. And also like property deductions, like the mortgage interest deduction can be split up using that same percentage. So for all of these kinds of things, it's great to get a higher proportion on the business side. And if your clients are not able to get a farm appraisal, they can also estimate the percentages, but then if they get audited by the IRS might lower that percentage and then you'll have to pay back taxes. And if they already have this situation, but they haven't done the appraisal yet, they can still get it and then do it going forward and amend their taxes for the last 3 years. Okay, last couple things. When does your business actually start for tax purposes? When you're starting up a new business, you can't start deducting expenses until the farmer business is actually functioning. So that means the first day that you plant an annual crop or hold an animal intended for sale or breeding. And then it's a little bit more complicated if you're doing permanent crops like fruit trees or things like that. Startup costs, the first 5,000 can be deducted immediately. The rest is deducted over the course of 15 years. There's other types of taxes. And then these resources are good ones to look at if your clients are having questions in your consultations. We learned that Pub 225 is better than the other tax publications because there's actually a taxpayer advocacy group that works on it and makes it more user-friendly. So definitely check that out. And then just to close, I think we wanted to say, there's probably going to be a lot of questions about things that you already know that we get asked at normal legal cafes, like nonprofit versus for-profit. So we tried to focus this presentation on things that you might not know about. But yeah, have confidence going forward. And then I don't know if we have any time for Q&A. I'll